Hi, I'm Chip Stites, and this is the Laughing Retirement. Today we're going to take a look at a market update. The reason being that as I read chat rooms and as I look at my newsletters and the things that I get that tell me the questions that people are asking and the things that are bothering them, I notice that worry and a certain amount of hysteria and the hype is rising. And that always bothers me. One of the reasons that it bothers me is that you put your portfolio together properly, you don't have to worry about any of this. So I thought it was time for a market update. And I'll look at where we are so that you might get a sense of what you should be doing right now. So here we are. I put this together on the 10th. It's designed for March 11th. And the question is, should you be worried or should you not worry? Very simply, let's take a look at where we are today, what the reality of today is. Well, since the highs of the market, the Dow's down 4% plus, let's say 5. The S&P's down around 6. The Nasdaq's down almost 10, but then they're the most volatile of indexes. And the Russell 2000, the small cap stocks that I look at carefully because that's kind of the health of the economy to me, are down 15. But since January 1st, everybody was happy at the end of January, right? Everybody was looking at things. Nobody was worried. We'd had a good month. The January effect said it wasn't going to be as big as last year, but it was going to be a positive year. Well, since January, the Dow's down 3.9, the S&P's down 4.5, the Nasdaq's down 7.3, and the Russell's down 10. Now, that's hardly cause for worry or hysteria. And yes, we're going through a lot of changes. And yes, we don't quite know where we are yet. But what are we looking at right now? Well, certainly, Ukraine and Gaza are a problem. There's a debt resolution before Congress to raise the debt ceiling. There's a budget issue in Congress. There's college campus unrest. There's the question of tariffs. There's news and politics. And incidentally, I am constantly reminded about what Warren Buffett said about news and politics. He said, I don't pay any attention to it. Well, the fact is, I don't either. I make few changes to my portfolio because my portfolio is doing what I want it to do, regardless of what the market does. I've set it up that way. Now, we've got a $36 trillion debt. That's 124% of our gross domestic product on an annual basis. And that's what's called nominal. Now, nominal means when you add inflation in. If you take out inflation, so what is called real gross domestic product, it's 122%. Either way, it's unsustainable. We will go broke. Very simple. Now, we are in many unique and unusual changes in this government right now. I know everybody doesn't like it. I know it's frightening to many people. I understand that. But stocks going up and stocks going down, the catalyst may be everything that's going on, but I'm here to tell you that I've been expecting this for a while. The Federal Reserve continues to battle with inflation. So if I look at the charts, the S&P 500 is coming down close to what's called the 200-day moving average. That's the average price of the stock over the last 200 days. And if it falls below that 200-day moving average, it just means that we've got further downside. Gold is almost at an all-time high. It's 1.5% off of its all-time high. All-time high is 29.56. Right now it's at 29.11. So gold, which is a harbinger of difficulty, it's a harbinger of a lot of changes. It's one place that people automatically go for a storehouse of safety. Gold is at an all-time high and staying there. Now, let's take a look at another way to look at the market. And this is actually more bothersome to me than all the other crap that goes on with politics and the news. And yes, I like it, and singing songs and tambourines and hating one guy and loving another. It's the PE ratio of the stock market. Well, what is that? That sounds very financial. It sounds very confusing. The price earnings ratio is the share price, what you paid for one share of stock, divided by the earnings the company made on that share of stock. The price you pay for stock divided by the company's earnings for that share of stock. It's really very simple. But why is it important? Well, to me, the PE ratio is important because it tells me how many years that company has to earn money at this rate to pay me back for the risk I took. I want to repeat that. The price earnings ratio, the share price divided by the earnings per share that the company made, is a way of telling me how many years I have to wait before the company is able to earn enough to justify what I paid for the stock. So let's take a look at that. Now I'm going to start on the right-hand side. I'm going to start over here, okay? The PE ratio of the S&P 500 right now is about 28.58. The historic norm is around 17 to 18. In other words, it's almost a 29, or it is more than half above the norm. Now, at 29, people say market's really risky. Well, we're there. The average of the last 15 years has been 19.4, but from 73 to 85, the PE ratio average in the market was 10. So the PE ratio is gradually going up. When I first came in, the PE ratio was a little bit above 10, but when I began looking at it and understanding it, they were saying, well, the history of the PE ratio is that the market's average about 15.7. Above 15.7, you're adding risk. Okay. Let's look at right now the sectors of the S&P 500 and the PE ratios in those sectors. Okay. Now, energy is 15.9 and financials are 17.91. Well, you'll notice that they're in green. That's because that's a place to look for a store of value right now. Two places that you can look: utilities, communication services, materials, and industrials are between 20 and 28. Consumer staples that everybody ran to, they were low just a short time ago. Consumer discretionary, healthcare, information technology, and real estate, they're all way above the acceptable range. So overall, the S&P 500 is at 28 when the norm is 18. That's too high. These are the things that I look at that make me concerned about where the market is today. So here's the bottom line. I don't believe this downturn is over. Now, could we have another run up? Sure, we could. Could we drop? For sure, yeah. The PE ratio is too high and there's too much uncertainty going on. But we could have an AI surge. The wars could end. They could solve those problems. You could see inflation coming down. Whoosh, markets right back up again. I don't think so. There's also something called reversion to the mean. That means markets tend to go back to their averages, which means that the PE ratio is going to have to fall at some point. It's been high for a while now. So I think that when you're looking at your portfolio, when you're considering what you should do, here's what I'd like you to consider. First thing I'd like you to consider is, if you own growth, take some profits. I own one of the Magnificent Seven stocks, but if you own all of them, as many mutual funds do, I would consider taking some profits. I would begin to look at value stocks and value ETFs that pay you dividends. Why is that? Why would I increase my dividend holdings right now? Because stocks that pay dividends don't drop as much as stocks that don't. And because stocks that pay dividends, the dividends drop even less than the stock. Dividends tend not to drop at all. So what do? Well, the first thing to do is to understand what your risk is. Do you know how much risk you're taking? Are you taking more or less risk than the S&P 500? You see, my risk right now is about 40% less than the S&P, or about 0.6. That is my risk at this moment. So my dividends are above 5.5%. If your dividends are up over 5%, you're taking less risk as a general rule. Unless you're buying, unless you're at 10 or 12 or 13%, then you're taking more risk the other way. But I would have you consider knowing what your risk is, knowing what the risk you're taking. Keep your risk low. I would say less than 0.60, which is called beta. My beta is less than 0.60. And keep your dividends high. Now, how do you start with this? Well, the first thing I would have you start doing is look at my videos. It's free. Look at the masterclass I've put in. It's free. Sign up for the masterclass that I have coming on March 29th at 11 Eastern Time and 8 a.m. Pacific Time. The masterclass will be about building a recession-proof portfolio now and through retirement. I don't need to change my portfolio right now. I never change it. I add to it. I don't buy and sell and buy and sell, because every time you buy and sell, you lose money. Somebody else makes money, but you lose money. If you don't feel you have the time, don't give up. Email me at info@thelaughingretirement and say, Chip, I don't have time. Do you have other choices? Yes, I have other choices. There are other things that you can do. Or you can schedule a 20-minute chat right here, and I'll be happy to talk to you about your situation. And you'll find I'm a no-pressure guy. This is your money. This is what you have to live with. I don't think you need me to tell you what to do. I think you should be interested in doing it for yourself. That is why this is important. So you got a couple things here to do. Watch some of my videos. Watch my masterclass. Look at signing up for the next masterclass, how to recession-proof your portfolio. Give me an email at info@thelaughingretirement.com, or sign up for a free 20-minute chat, and we'll look at your portfolio and what you need to do. So I hope that market update made sense to you. I hope you realize that we are in a time of volatility, that we are at a time when everything is changing rather quickly. And I hope you will realize that you can put together a portfolio so that you can spend your entire retirement and the time before it laughing and not worrying about anything. I'm Chip Stites, and this is The Laughing Retirement.